Hello and welcome to the ASB Investment Podcast, a show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that'll be happy to chat if you need.
Welcome to the latest episode of the ASB Investment Podcast. Now, it's been a bit of a while since our last episode, with the last one being in about June, and I was looking through our episodes we've recorded so far this year and the titles and topics we've covered, and the year's kind of been broadly representative of those predictions. And there was terms being used like it's going to be bumpy, rising interest rates, challenging was another one. This year's going to be certainly different, or it could be much better from 2022. They were the key themes that we've talked about. But one topic we haven't really spoken about much in great detail, at least, is around responsible investing. And it's one that's never been too far from investors, politicians, business leaders' minds. And on that theme, we have an extra special guest today, all the way from Australia, Iris Davila, who is the Head of Investment Stewardship for Australia and New Zealand at BlackRock. Iris, welcome. And let's start off by telling the listeners a little bit more about you, your role at BlackRock, and how you got into stewardship, and maybe even what even is stewardship.
Okay. Well, hello. Thank you so much for having me here today. I am very proud to say that I have been at BlackRock for 25 years and have spent most of that time, believe it or not, in Australia, in Sydney, so the last 19. I did start as a grad and have loved the fact that I've been able to grow up at the firm. I've been given many different opportunities through the years as we've grown. And about 5 years ago, I found myself in what is called investment stewardship. Now, What exactly is investment stewardship? Because I somewhat had to ask myself when I took the role. And we think of stewardship, firstly, I always say first and foremost, we're a fiduciary on behalf of clients.
Sure.
And that is irrespective if you're in the stewardship team. If you work at BlackRock, that's what you are. You're a fiduciary. That means you are managing other people's money. It's not your money.
Yeah.
And if you're managing other people's money, you have to be very responsible and considerate and careful about how you're managing that money. And that's where I think stewardship plays a really strong, important purpose for BlackRock, and particularly the assets we hold on behalf of clients. So we're really trying to promote long-term sustainable business practices at the companies that we hold on behalf of clients. So what does that mean?
Yeah.
It means we're meeting with companies that we own, so predominantly equity holdings, because stewardship has several roles. One, corporate engagement, so meeting with companies and really trying to drill down and understand the risks and the opportunities that they have so that we can ensure that they're there for today, tomorrow, and in the long term. The second part of the job is voting. I'm sure you know what a AGM, an annual general meeting is, or an EGM, or an annual shareholder meeting, ASM, various terms. So we use the engagements that we do, and we vote at the annual AGMs or EGMs or ECMs, ACMs, whatever acronym.
Yeah.
And then the third part of the job is doing things like this, really trying to speak to clients, speak to various stakeholders, to educate them a little bit about stewardship and how we hopefully add value to our clients over time.
And so being a fiduciary, a stewardship is a core part of that. And I guess I'm just testing if this is correct, playing it back to you. And then a couple of the key ways are voting and engagement. Is that correct?
Correct. Yes.
Okay, cool.
Stewardship. We often say there are various parts of the toolkit that you can use in stewardship. So engagement for us is where we spend the majority of our time. So again, we're meeting with the companies. We're aiming to cover about 75% of the assets we hold on behalf of clients. And then in voting is the second part of the stewardship toolkit, where we are actually deciding whether we're going to support companies and management and boards, or we're going to vote against companies, management, and boards.
And so outside of our broader partnership with you and BlackRock, on an asset class basis, you've been, I guess, helping us in managing it, specifically our emerging markets and global equities since about, in and around 2017. Now, part of this includes undertaking engagement in voting, what you've described, on our behalf in these portfolios. But ASB obviously isn't the only fund manager you do this for or work with. So to help paint the picture for listeners, Can you explain a little bit more, I guess building on what you've said in the intro, what it looks like to carry out engagement and voting on behalf of us or clients?
Sure. And you bring up a very good and important point. Again, we are a fiduciary. But secondly, we had wide-ranging group of clients. We have institutional clients, we have retail clients, we have mom and dad investors, probably less so of the latter. But in order to be a good fiduciary, we think good stewardship is, again, trying to have a very moderate and measured voice and really trying to understand how companies are managing future and potential risks. But it's actually really tricky to be sort of that, moderate and measured voice because, as you can imagine, people have very different values system, and we are not focused on the values. We're very much focused on protecting the value of the investments that we hold on behalf of clients. And so for us, it's incumbent on us to be very transparent about the way we think about stewardship, what our principles are, what we're talking to companies about, and to be very clear when we're going to be supporting companies at AGMs and when we're not going to be supporting companies at AGM and how we're going to use our vote. We always think about voting as sort of a secondary measure. We really hope that we are having constructive conversations year over year, 5, 10, 15. Not me. I'm not going to be here in 20 years' time. But newsflash. But in 20 years' time, hopefully someone from BlackRock will still be talking to companies and really trying to drill down and understand how they themselves are protecting the value of their own company for future investors.
So that's the engagement part.
That's the engagement part, yeah.
And so you were mentioning engagement on a moderate and measured, approach as such. If I can just tease that out a bit more, moderate and measured being the opposite of what other types?
So oftentimes there is a view that we should be activist investors.
Right.
We are not activist investors, and we need to be very clear and transparent that that's not who we are. We are active stewards. You've heard me say this before. Even an investment into an index fund is an active decision. Mm-hmm. We take an active approach to, again, trying to protect and maintain that long-term value of the companies we hold on behalf of clients over the long term. To do that, we really spend time, money, energy, resources meeting with these companies in order to ensure that. We're very fortunate. We have about 70 people globally who are part of the investment stewardship team. And again, we're meeting the majority of the companies, around 75% of the assets we hold. And again, really trying to understand what's driving these companies, what's their purpose, what's their financial resilience, what's their board composition, how they're paying their executives, what are their company impacts on people, the climate and natural risk as well. So these are all things that we're taking, that we're speaking to companies on behalf of clients. Very importantly, and this is where the distinction, I think, again, between moderate and measured, and we're very focused on that long-term view. We are not telling companies what to do. And I think that's what an activist investor likes to do and wants to do.
Right.
So we're encouraging better, longer-term business practices, but we're not telling companies what to do.
Which I guess is so applicable for the majority of investors, or the average investor who is going to be long-term minded, right?
Correct. I mean, if you think again, if I take it up a level and I look at our clients and that the assets that we're managing on behalf of our clients, the majority of clients that we invest on behalf of, it's retirement money, it's pension money, it's superannuation money, it's people saving for houses, for colleges, for a longer term thing in the future, right? And so again, what we're really trying to help companies understand is that if they are really focusing on this long term, there's so much short-term noise, particularly in markets, particularly from active investors, particularly from activists, that we actually think having a long-term perspective on many things will be sustainable for these companies rather than thinking way too much on the short-term quarter-over-quarter earnings.
I guess it's in the interest of, correct me if I'm wrong, in BlackRock, the investors, for those, or for the majority, if not all companies, to endure, right, and be around for a long time?
Absolutely. I mean, if you're an investor, you're hoping, right? You're giving money to a company and you want them to be here in a year's time.
Yeah.
You want them to be here in 5 years' time. You want them to be here in 10, 15, 20, 30 years' time. And so you want to make sure that the way that they're managing their business and the way that they're managing their risk and their opportunity is aligned with that long-term perspective versus sometimes companies are too short-minded. And CEOs, let's be honest, CEOs, an average tenure of a CEO is 5 to 7 years. So they're perhaps wanting to maximize profit in the short term at the cost of the long term. And so when we're speaking to companies, we really are trying to encourage them to think past one business cycle, really think out into the future. And what are you doing today to ensure that you're still viable in that longer path, in that 20, 30, 40 years down the line?
Because I guess that investor's capital has a longer time frame than a potential CEO cycle.
Absolutely.
Right. And so for us at ASB, as you were saying, there's, going passive or indexing is an active decision. And for the majority of our funds and where we have money allocated, currently we utilize an index tracking style. Can you give the listeners some insight into what engagement and voting looks like on a day-to-day basis for index-managed investments?
So I'm perhaps a little biased,
Right.
as you would expect me to be, but I think there's quite a bit of power in being an indexed investor. And I need to be careful about using that word power. But if you think about it, again, because we are holding this company for a very long time. We're not chopping and changing. We're not, and there's nothing wrong. We have active fundamental managers as well. We work a lot with them. I've mentioned that to you before.
Yeah.
But we are, again, holding this company through good, bad, and ugly. And so what we're trying to encourage these companies is to focus on the good and to minimize or reduce the bad and ugly so that they're, again, there for that longer term. And as an index investor, we're having conversations at least once a year with the same company. Obviously, it'll be with different people as their management and boards change. But BlackRock, as an investor, will be holding this company today. It's in an index fund. If it's still in the index in a year's time, we'll be meeting you again, encouraging you to think about these risks and how you're going to manage them and the opportunities. We're going to be speaking to you again in 5 years' time. I mean, hopefully we're having more than one conversation in 5 years' time. Yeah. But the point is, it is an iterative process. It is building year over year.
And I guess because there's such a almost infinite universe of companies, but for the ones that you would, I guess, we were talking earlier, the ones that you, in the sort of universe, you can get round and interact with, how often would you say you're either in an average year talking to or meeting with?
Sure. It depends on the company. It depends on the sector. It depends when the companies we're predominantly focused on, that sort of 75% that I mentioned of the equities we hold. It really comes down to our large holdings. It comes down to our climate universe, which is a group of 1,000 companies across our entire equity portfolio that cover about 90% of the carbon emissions in our equity book. Okay. So that's 1,000 companies that, as a team, again, we're covering. It covers companies. There's a thing called an MSCI controversy list. So any of the companies that are on that list that might be having issues. It covers what could be potentially contentious companies, i.e. someone who's been in the news, someone who's having an issue, someone who's trying to transition to something. So it's very much focused on that that flavor. We obviously cover a lot of our fundamental active holdings as well and have great dialogue with those fundamental active equity investors that sit alongside us. So that is where we spend the majority of our time. And again, it depends on a company and it depends on, if you have a company that's going through several issues, your engagement might be more than once a year.
Yeah, of course.
If it's a company where, 80% of companies are actually, particularly in a developed market, they are traveling all right? So we'll meet them once a year to try to inform our voting at AGMs. It's a pretty standard understanding what, how their board, the composition, how their employees are traveling, how they're thinking about their human capital management piece. But that's pretty standard. And then you'll have problems.
Right, okay.
And then when you have problems, you do tend to engage a little bit more, or there'll be an activist situation where you might need to get involved in, not from an activist investor perspective, but because there's something on the ballot that you need to become informed about to decide and make a view. And take a view.
So sometimes can activists be a catalyst for you guys to have to do additional work on a particular company?
Sometimes, yes. It's certainly by no means an only driver. Again, our starting point will always be our engagement priorities, our engagement principles, and also our list in terms of, and when I say list, again, where are our holdings, where are our risks, who's on our universe of companies that we want to engage in. But yes, certainly in activist situations, our view is to try to understand, and this is what comes back to moderate and measured, try to understand both sides of the equation, right?
I guess it could be that the activist point of view or driver could be counter to long-term stewardship?
Could be entirely counter to long-term stewardship, or it could be from a minority perspective, or it could be counter to our client's interest, or it could be overly prescriptive, or it could be overly disruptive to a company. Oftentimes, you get activist situations that can be wanting to spill a board.
Yes. Yeah, and replace them.
Replace them, right?
Yeah.
Is that necessarily in a company's best interest to have your entire board spilled?
Arguably not.
Arguably not.
Yeah.
So that might be in a particular shareholder set's best interest, but that's not necessarily in a minority shareholder's best interest.
Yeah, and you would evaluate that on its merits.
Right.
Yeah.
So we do like to, and that's what I mean by measured. We really want to understand both sides of most arguments and then come to a conclusion.
Patient capital.
Patient capital. Sometimes impatient, just kidding.
So one area that I'm particularly interested in as an investor myself, but also just in terms of the topic we're on today, is the difference between countries and regions and, how they affect engagement in voting. Now, for instance, developed versus emerging, or I guess whether that's also sort of older versus younger countries, but different laws and customs as well. How does the country or this, I guess, emerging versus developed, and how they operate and they affect how you might interact with them?
I think that's a great question, and it's one that I think this is where BlackRock really shines, because again, we've got a team of 70 people. We're organized regionally.
And it's worldwide?
Worldwide. Yep. Mr. Worldwide, just kidding. So we have teams on the ground in various markets. So for instance, you'll hear me say we have a Japanese team engaging with Japanese corporates in Japanese. As a client, I think that's incredibly valuable information and insight that we bring relative to perhaps others.
And we couldn't do that ourselves.
It's hard. 70 people, that's a lot of people that's a lot of resources,
a
lot of time, energy, and money, right? That we have put forward to this initiative because, again, we believe stewardship is core to our fiduciary duty. We have a team based in Singapore engaging in Southeast Asian markets. And to get directly to your question, there is a difference, and whether you call it developed world or emerging markets, for me, a lot of it is how mature from a governance perspective are some of these markets and some of these companies. And so it will be slightly different in an emerging market than it will be from a developed market. So corporate governance in Australia is going to be different than corporate governance in Korea, for instance, right? Or South Korea, right? So it's having knowledge of the nuances of the local regulation of the market practices, I think, is a value add for clients. And so your engagement is slightly different. And it also depends on market structures, because in a developed market, shareholders do have quite a few rights in terms of ability to meet with companies, engage with companies, voting rights. In some of the emerging market countries, it's a little bit more challenging at times because either they're family controlled, so shareholders, your average shareholder would have less ability to influence or impact or access even. So you do have to approach it slightly differently. In saying that, we do overall stick to our guidelines and our principles. We do have local market guidelines in most of the major markets that we're operating and voting in, and so we try to be very clear for our clients to help them understand how we're going to be approaching various situations. Now, I do think, and if we talked about this a little bit in different forums, but it's always difficult to measure impact in stewardship. And I personally think it's a little challenging in some of the more developed markets, where there are a lot of investors who, to be fair, we're not the only ones. I'm always loath to claim credit for anything. There are many investors who are advocating and are trying to encourage companies to frankly be better or adopt some of these better business practices. In the emerging markets, I think you can have a little bit more impact because there's fewer investors who are actually asking, developed market questions, let's say. Yeah. And so I think that's a benefit that the stewardship team does provide to overall markets development, transparency, disclosure, et cetera. So it is slightly different.
And there's because one thing is I've always had top of mind is whether I read or heard, how do some of the developed markets and countries that have already gone through their kind of couple of 100 years of revolution and really gotten going, how do we then justify or engage with, I always think of Africa, I think, is earlier on in its emergence. Mm-hmm. So, how do we, what right do we have to tell them how to do things on where they are on their journey? So where I was going with that was, are there any regions that stand out to you as ones you have to be particularly careful with?
Well, I think if we bring it back to basic principles, we're not telling companies what to do, because I agree. It's very hard to be telling any region or any company to do something, particularly when you're not there on the ground or working at this company or part of the executive or the board. That's not the role of a good steward. I think as investors, there is knowledge that can be, and again, this is where it comes back to the point of transparency. If a developed market company has very good transparency and disclosure in a particular sector, then that actually benefits an emerging market company in the same sector. Yeah. And companies will openly say that, there are leaders in certain sectors and best practice and better practices, let's call it, because nobody's perfect, as I always say. So there's better practices. And so I think that's why that transparency is important. It's important for the investors and it's important for companies themselves as well.
And I guess some of the key things we see around the world, whether it's in emerging markets or developed or across the board, centre on things like maybe, director nominations, REM, climate-related matters, extracting more value, shareholder value and capital returns. They're the things that always stand out to me. But what are the key focuses of engagement that you guys have top of mind at the moment? And whether that's those 5 principles you've talked about or anything you want to expand on that's different to that?
And it is along those 5 principles that I mentioned, but it does bring up a good point and why we're very principles-based to begin with. Because it's hard to prepare for the unexpected, right?
And you don't know what you don't know.
You don't know what you don't know. If risk weren't risk, you would know about it, right?
Yep.
So I think it's important to get the principles right and the basics right. And so we will always say that we start with what I would call good old-fashioned governance, right? So if you think about, what does a board look like? What is the governance of the company? What's the operating structure? That's critically important for companies, because if that is not right, all of the other issues are not going to fall into place.
It's the foundation.
It is the foundation. So we do spend a lot of time on board composition effectiveness. That does allow you to have various conversations. It allows you to bring in whatever thematic is currently in place, whether it is, labor shortages, gas shortages, electricity prices, transition. That is pretty general that you can bring into this one conversation. How is the board thinking about this? The company impacts on people, again, that's fairly broad-based, but that'll change. Is it COVID? Is it retention? Is it labor shortage? Aging workforce.
Yeah.
Is it demographics, right? So that's fairly principle and broad, but it does allow you to have that conversation and zero it in depending on the company you're speaking to, depending on the sector you're speaking to, right? Compensation, executive remuneration. We always want to see that companies are, again, incentivizing their people in alignment with a long-term strategy.
Yeah, right. Yeah.
Right? That's critically important.
Yeah.
And so how are executive teams being compensated? And is that in line with you as a shareholder, your experience of that investment?
Yeah.
And so, again, that will change from time to time, but it's fairly broad-based, but you can really zero into a conversation and try to understand how a company is thinking about this.
So they're aligned to be stewards of the business,
correct,
just as you are as an owner.
Correct.
Are there any emerging or future areas that you think are going to get only more important?
I think bringing it back to demographics, and we talk a lot about how we are going to manage that generational shift, generational way of working, attracting human capital, keeping it. Is there enough skill sets in certain industries? It's a real problem in certain sectors. And so how are companies thinking about that? You've got things like cyber, ever important. And how are boards thinking about that? Are they really focusing on these risks? Again, it's ever changing, and that's why I actually quite like the way we approach our principles and our guidelines, because it does allow for that evolution of how things are going to evolve. And frankly, as it is an iterative process, so companies are learning, they are improving, and then you continue to sort of raise the bar and continue to standards evolve, standards improve, expectations increase from investors, from their own employees.
So, I guess it's never going to go the other way, is it? Standards are never going to go.
I really hope not.
Right. Now, when you have savings or your savings in investments as such, and I'm talking mostly about equities here, I think a lot of people don't necessarily realise that they're an owner of a part of a company. And albeit for most of us, that's likely to be a very small amount on that company's shareholder register as such. But for KiwiSaver, that ownership stake is pooled amongst others as well. So it can be rather powerful. In terms of, how you've helped or what you've done around our customers' portfolios, can you give us a bit of a flavour in terms of what those engagements have delivered or, what you've tried to do?
Sure. And I think it comes back to a few of the things that we've already touched on. We are using our voice as an investor to reflect some of the questions that we get from our clients. Right? And so the issues that are important to them into their portfolios, and we're trying to also apply that long-term lens and perspective to it. So for us, if companies are improving year over year, this is an iterative process. It's not a snapshot in time. So whether it be, if I think about climate, which is perhaps one of the more specific ones where I think it becomes a little bit more tangible, if we think about what the TCFD framework is and where companies were in 2017 when it was first launched, when nobody knew what it was.
And TCFD, that's the climate-related disclosures.
Yes,
okay, just so our listeners knew that there was another bank acronym in there.
Sorry about that. Yes. So where they were in 2017 versus where a lot of the collective, let's say, because it's, again, not just BlackRock, there are many investors who are asking these questions, where those disclosures are today, that has vastly improved. Why is that important? It is important because it really helps us as investors to understand how companies are managing what is an important investment risk, climate risk. It is one of those important risks. So the better those disclosures are, the more that we are speaking to companies and encouraging them to adopt a certain framework, that allows us as investors to have a look at those companies and decide certain companies are better prepared for this transition versus others. And then investors can make the decision on whether or not they want to take that risk on or not. And so it's hard to be specific about how you measure things. That's one of the most challenging things about the stewardship role.
I can imagine.
But it is that improvement year over year, time after time.
What was the term again?
The measured and...
Yeah, it's the one. Yeah. And I can imagine that not all engagements necessarily are successful, or you might meet other parties who are pushing a counter view. Have there been any unsuccessful engagements, impacting value across the portfolios or in your wider, remit?
Look, I think, again, it's everything's a snapshot in time. How we would define failed engagement, and failed is perhaps too strong of a word, but because it is an iterative conversation, you might have a conversation with a company over a few years. And we, again, try to be very patient investors, and because we're focused on the long term. But if we believe that a company is beginning to be a laggard on a particular topic, again, climate is a great example, then at that point, we will take voting action, usually at a director level, because again, going back to basic principles, holding directors to account for us is the highest form of accountability,
Sure,
right?
yeah.
So we may take votes against directors to demonstrate
You mean business?
to demonstrate that our patience is wearing thin.
Sure, yeah.
So we would like to see additional progress on this issue. This risk is not being focused on as much as it should be focused on. That is oftentimes a sign of less successful engagement. But again, that's a point in time, because then the following year, you might be engaging with that same company that you've voted against, and they will have started to make progress again. And so you will support them and support until they sort of stop making progress. REM reports tend to be one where you do get a lot of against votes on things. And again, votes, the biggest thing I always say is just a snapshot in time.
Sure.
But it usually happens when a company, again, has not articulated well why they've done something, or they have not articulated. Oftentimes there's a bonus or a retention payment that is counter to long-term investor perspectives, and they have not articulated it well. They have not spoken to their investors about it ahead of time. And so oftentimes you'll see, maybe a vote
Voted
against.
down.
You see that voted down because, again, the articulation hasn't been there. It's not clear how it's tied to long-term strategy.
So that's basic stakeholder management.
Correct.
Right. Okay. And do you think that, does a company respond, I always think of the burning platform analogy, but does a company respond better to engagement if something maybe negative has been a catalyst, or, they've experienced a negative event?
Are companies more responsive when they're getting a lot of, again, similar asks from various investors? I do think they are. It doesn't necessarily need to be a negative catalyst. So it doesn't necessarily need to be an against vote on something. If you take it back to emerging markets a little bit, and this is where you start seeing a little bit of nuances, some companies don't respond well to negative votes. They'll cut off ability to speak to them. They don't like to be named and shamed.
The fight or flight reaction.
Yes, correct. And that's why, again, we're always trying to have that constructive, long-term measured perspective. And so we think there is value in engagement, and we will continue to focus most of our efforts on engagement. A vote is just a snapshot in time. Sometimes it is, again, it's a part of the toolkit. Sometimes it is effective.
Yeah.
Sometimes it's a circuit breaker, in terms of, so we've been on this for now a few years.
Yeah. It's like clean up your room. Now I'm going to tell you to actually do it, please.
Yes.
Okay.
Yeah. So it's a snapshot, and I think it's important to have both.
Yeah, I guess, as you say, tools in the toolkit, and when you need to play either card, you've got it there.
Correct. But you also, you need to be balanced about how you do it. You can't just vote no on stuff all the time. That's not effective. You can't engage all the time without taking voting action. It is a delicate balance and art.
And the best stewards, I guess, know how to paint the best picture.
Correct. Hopefully for our clients' interest.
Sure. Okay, so we're nearly at the finish line, but I've a couple of final questions as we wrap things up. Now, are there any particular engagements you're hoping might deliver value in the next 12 months? I guess that could be, again, those broad principles or themes as opposed to specific ones, company specific.
Sure. Just in the broadest terms, I think the climate universe, the climate focus universe that we've developed is something that we've spent quite a bit of time on internally, and we're hoping to continue to evolve that and hopefully in the future be able to, if you think about impact, it's very difficult to manage and to quantify. So how do you start thinking about how we can quantify some of the impact, quote unquote, that we have? I think climate is one where the urgency continues to grow. It is a risk. And so we would like to see more companies adopting the TCFD framework, more companies getting really clear and focused on the transparency around
so doing it like on an elective basis,
yes,
as opposed to those that are legislative requirement to do it.
Yes, because it's very few countries that legislate.
Right.
New Zealand, yes, but a lot of countries do not.
Sure. Yeah.
So we want to see a greater adoption of what is a very important investment risk of that. So that to us is something that we will continue to focus on. We will continue to focus on board diversity. It's something that's important. What we definitely saw through the COVID period and what we see with the demographic changes that we're seeing is there is a bit of overboarding that's happening for certain directors.
Overboarding?
Overboarding as in one board member sitting on too many boards.
Right. Okay. Yeah.
Yes.
Yeah. Spread too thin.
They're spread too thin. So we need, for board members to not be spread too thin, we need to continue to see generational succession, right? And so we want to see new faces at board tables.
Yeah, right.
We would preferably like to see a diversity of faces at board tables. And I want to be very clear about the definition of diversity. Diversity is diversity of thought. It's all well and good for I always say, as much as I would love to see a board of all irises, that is not diversity.
Right, yeah.
That's right, because that is not diversity
What
of
is
thought.
it? When we're all thinking the same, nobody's thinking.
Correct, right? So it's true diversity of thought, of background, of experience. You've seen some great boards, specifically in Australia, start to embrace younger, ASX-listed director boards become board members, right?
Yeah.
That's fantastic because that brings a different lens, especially if it's from a sector that company needs that experience in.
And whose primary customer potentially is that.
Correct.
Right.
Yes. So you want to see a bit more progress on this front. So those are a few things that we're thinking about.
And I guess just related to that in terms of, diversity stands out as one, but and more transparency on climate reporting. But are there any other things that are concerning you that companies are not doing or should be?
Look, I think, again, it's so challenging because the human capital management front, I think, is incredibly important for us and for companies. And managing the post-COVID experience, I think, is one that many companies are challenged with in terms of whether it's return to work mandates, whether it's trying to bring people back in. And look, again, I love coming into an office. I think it's fantastic. I enjoy it. How do you get that magic back into people back in and that magic? How are companies thinking about that? Because again, it comes back to that generational succession that you need at companies as well. So that's a potential risk. How are they thinking about that? How are they thinking about incentivizing their employees? At the end of the day, we all want to come to work for a purpose, for a reason, et cetera. Are companies doing that?
Yeah, and I guess if you are seeing a lot of people not wanting to come into the office, then the generation after that, are they going to be inclined to do even less? And what does that mean for my capital that's at risk and so on?
What does that mean for the long-term prospects of that company?
Right.
If you can't attract employees, you're having an issue.
Sure. And my final question, which actually came from our catch-up earlier today when we were just discussing all things stewardship, but I think if you're a listener who's tuning in, who's like a company owner, let alone an investor, but if you own a company and you're thinking, what does this have to do necessarily with me? But the thing that stood out for what Iris was telling me earlier was the attraction of capital in the future, or even now, but in the future, stewardship can play a critically important part in that, because I guess if you're out seeking new investors or, retaining the capital in your business, you don't want any, reasons for that capital for capital flight. So can you just, if you're, for a business owner who's listening in, what are the benefits to companies for aligning to, what you've articulated in this whole podcast?
Sure. That's perhaps one of the more constructive conversations we do try to have with companies, and try to say the reason investors are asking for this additional transparency and disclosure is not because we're trying to be painful.
Yeah.
It's not because we want you to do more work or to spend more money unnecessarily. We're asking for what we believe will be decision-useful information for investors. I can tell you from an internal perspective and from an investment lens, we require quite a bit of information to be able to, again, understand the risk and opportunities that companies are facing. That information then allows portfolio managers, investors, to decide what risk profile they're going to use to construct portfolios.
Sure.
If you don't have that information available, you're almost ruling yourself out of a capital allocation decision. So aren't you better off providing information that investors believe is decision useful and giving yourself the chance to be ruled into capital allocation decisions.
Yeah. And not, I guess, the counterfactual prevent you from being ruled out.
And prevent you from being ruled out.
Yeah.
Exactly. So I often say this, help us help you.
Yeah.
What we're asking and encouraging you, whether it's a standard, whether it's additional information, whether it's this piece of disclosure, is really through that investor lens. And it's information that investors are asking us so that they can make decisions and allocate to portfolios or not allocate.
Right. All right. Well, I think we've reached the conclusion of the formal questions, and I guess I'm pleased to get to the question that I always ask people at the end, and it's produced some great answers in the past, along with my reading habits, of course. But so the final question: what is something you're reading or watching? And again, it doesn't have to be business or investing related that you can share with listeners.
All right. I'll give you a funny one just so you can laugh at my expense.
Great.
And it's based on the fact that I have a preteen and teenage daughter, but I just finished reading The Summer I Turned Pretty.
Great.
And that's because we're about to start watching it as a TV series.
Oh, of course.
So I'm a big believer you read a book before you watch a series or a movie.
Okay, so you read Harry Potter then before...
I did not read Harry Potter. I watched the movie, sorry.
Okay, I haven't either, so that's fine.
So no, my kids were not Harry Potter kids. No, they're into The Summer I Turned Pretty.
Great.
Yeah.
Okay, and so are there any stewardship themes through The Summer I Turned Pretty?
I'm not sure. But if you want stewardship things, I actually have another great book that I just finished. And I think the lady's name is Edith Eger, but it's called The Choice. And it's a Holocaust survivor. And she then went and moved to the U.S., became a psychologist, and the lessons that she learned from the Holocaust and how she's translated it into her life. And it's really quite moving and
wow.
Really impactful. So serious and fun, and a funny one.
And so just to get, what was the title of that one?
The Choice.
The Choice. Okay, I'll note that down on my...
And it kind of aligns with what we've been talking about. We
Yeah.
provide choice. This is, choice individuals can make in terms of how you confront adversity and develop resilience.
Yeah, and what you do about it. Amazing. Well, thank you very much for that. And I'd like to, I guess, obviously thank you for stopping by. I know you're it's a whirlwind trip of New Zealand. You go back tomorrow, but and genuinely it's helped me understand, and I know for our team as well at ASB, the concepts of stewardship a little bit more, voting engagement, and also the part that, BlackRock plays within that. It certainly illustrates to me that, there is a lot going on. A team of 70, including yourself, very active in your engagement in stewardship. So again, a massive thank you for coming along and spending time with us. To our listeners, we'll be back in a few weeks with our next episode, so keep a lookout for that. And in the meantime, thank you as always for listening, and it's bye for now.
Thanks for listening to the ASB Investment Podcast. If you have any thoughts on today's episode, or if there's anything you'd like us to discuss on a future show, get in touch at podcasts@asb.co.nz.